Hi everyone, this is Arpita Gupta, founder director of NiveshMitra.com, and today we are here to discuss the Russia-Ukraine crisis, its impact on the world economy, Indian economy, and how exactly should you position your investment portfolio amongst all this fear and chaos. So coming back to the basics on how stock markets work, they tend to follow the earnings growth of the underlying companies, and hence to understand how the markets will respond in the coming times, in the immediate future and medium to long term, we need to first understand its impact, the war's impact on world economy and the Indian economy. Now, talking about the impact on the global GDP, number one will be the direct impact on Russia and Ukraine's GDP, who cumulatively contribute to just 2% of the global GDP. But what about the spillover effects to the other parts of the world? The major impact will and is already being felt through is the commodities, oil and natural gas specifically. So Russia provides approximately 17% of the world's crude oil requirements, and we have all seen Brent crude prices shoot to $110 a barrel, even more than 2014 levels. Also, Russia is a major natural gas supplier to Europe, 20% specifically, and approximately 60% of Germany's natural gas requirements is dependent on Russia. Impact on the Indian economy. India being a major importer of crude oil, this increase in oil prices will definitely increase our current account deficit and put a pressure on profit margins of the companies. But the silver lining here is US is trying to enter into a deal with other OPEC countries to increase the oil supply and hence control the prices. So what about the overall outlook on the Indian economy? Indian economy couldn't be at a better place right now. Corporate and household balance sheets are stronger than before. High government incentives in the form of PLI. MNCs are looking to expand their manufacturing bases in India because of China plus one and low corporate taxes. And this effect is already being, started to see on grounds. Companies are posting better profits and earnings growth, and we see a strong consumer demand. Now, again, playing devil's advocate, the positives are the Indian economy is strong and on a path for high earnings growth in the next 5 to 7 years. While the risks are due to rising inflation, profit margins are squeezing. And this year, number two, this year, Fed and RBI are set to rise interest rates, which generally is considered not good for the markets. Now let's quickly see how have the markets responded in the past to a war situation. The first table shows the US markets in times of war have gone for a correction of approximately 10 to 15%, but have rebounded strongly in the next 3 to 6 months by rising by as much as 20%. Similarly, the Indian stock markets have seen an average downside of 16.5% in war situations, so a correction of 16, 15, 16%. But after 3 and 6 months, they've risen by an average by 23 and 34% respectively. So there is short term pain definitely, but markets prove to be resilient in the medium to long term. How are the markets currently valued? Will we see more correction? This is one of the biggest questions that I hear from a lot of investors. Honestly, predicting the next 15 days, 1 month is very tough, and it depends on various factors like what shape will the war take, investor sentiments, and all of that. But when we talk about the current valuations, the historical average PE of the Indian stock market is 18 and a half. And at current levels, we are somewhere around 19 PE. So markets are fairly valued, not cheap, not expensive. SIPs work during best during this time. If you want to deploy a lump sum capital, stagger it over 4 to 6 months period with an increased buying if Nifty goes anywhere below 16,500. The next thing, very important, is invest in sector leaders. So they can pass on the pressure of rising input costs to the end consumer and hence maintain their profit margins. So, what is the conclusion? We are positive on the Indian equities for the next 5 to 7 years. If you have that kind of time horizon and are already invested, stay invested. This too shall pass. If you're investing via SIP, it couldn't be a better time to invest via SIP. But if Nifty goes below 16,500, try to prepone your SIPs and buy those levels. It's a very attractive level. If you have cash to deploy, don't invest all at once. Stagger your investments across 4 to 6 months, buy on dips. Please note such corrections are the time in market when you have a good opportunity to make money, and hence please do not panic. Know the right pockets of opportunity and add to your positions in equity. Or if already invested, breathe, stay patient, hold on. Happy investing.